Welcome back to Investing Talk Podcast.
Today we're looking at Webull.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. Webull has been one of those, one of the most talked about disruptors in the fintech brokerage space for years.
For sure, everyone's been watching them.
Right. But what we saw recently, specifically in the third quarter of 2025, it wasn't just another quarter of growth. It was a fundamental, transformative financial inflection point.
That's really the core thesis here, isn't it? For years, the story was, great platform, but are they ever going to make serious money?
Exactly. That was a big question.
And Q3 2025 just answered that with a resounding yes. We saw revenue shoot up by 55% year over year, hitting what, $156.9 million?
And what's fascinating to me is that this was a sequential acceleration. The growth is actually picking up speed compared to previous quarters. It wasn't a fluke. The market loves growth, but it rewards profitability. And the most telling data point for me is the swing to net income.
A massive swing.
They reported a substantial $36.9 million in net income for the quarter. Just think about that compared to a loss in the prior year. You could just see the power of their scale kicking in.
And that's that term we always use, right? Operational leverage.
That's it, exactly.
For the listener, maybe we should unpack that a bit. It just means they're fixed costs, maintaining the trading platform, the servers, compliance stuff. Those are barely rising.
Right, they're staying pretty flat.
Even as their revenue just skyrockets. So every new dollar of revenue falls straight through to the bottom line much, much more efficiently than it used to.
Precisely. The adjusted operating profit was almost identical to the net income, at a strong $36.8 million. And this makes it 4 straight quarters of operating profitability.
So it's a trend.
It's a trend, and it fundamentally shifts the investment narrative from, a hopeful disruptor to a proven high-margin business model.
And if you look under the hood at what was fueling that, it was the hyper-engaged user base, right? Trading-related revenue surged even faster than overall revenue.
Yeah, up 64% year over year. That just shows highly elevated user engagement. I mean, active traders are doing a lot of business, and their monetization engine is just incredibly efficient.
So it's not just attracting beginners anymore, it's monetizing some pretty sophisticated retail flow.
And that efficiency is built upon a much larger base of wealth. When we look at the platform metrics, they show this sustained adoption by, I'd say, more serious investors.
You mean the customer assets?
Yeah, customer assets expanded dramatically. They jumped a massive 84% year over year.
Which brought them to a staggering $21.2 billion in total customer assets. I mean, that's almost doubling the assets they held just 12 months ago.
And look, market recovery helped a bit.
Of course.
But the core driver was strong net deposits. We're talking $2.1 billion in that quarter alone. That's serious new money moving onto the platform.
Right.
People are trusting them with large balances.
And those balances are clearly being put to work. The volume numbers are huge.
Oh, absolutely. Equity notional trading volume grew 71% to $204 billion. And when we say notional volume, we just mean the total dollar value of all the trades.
$204 billion. That shows they're really attracting those high-volume active traders who generate the bulk of the revenue. So the volumes and assets are impressive, but what about the stability of the company itself? We have to look at the balance sheet.
Right, and it tells a story of financial prudence, which is just crucial for a global fintech company. They maintain a very conservative capital structure.
Their debt-to-equity ratio is low, right?
Very low, about 10.0%. This isn't a firm that's leveraged up to its eyeballs. Plus, they have tons of liquidity, $1.18 billion in cash and cash equivalents.
So they're not scrambling for cash to fund their growth. They're sitting on a really strong foundation.
And speaking of funding that growth, we have to talk about that big standby equity agreement they secured back in July 2025.
The billion-dollar one.
The billion-dollar one. Think of that as the ultimate war chest.
Yeah.
The dry powder, as we call it.
It's a massive strategic advantage.
It really is. It gives them incredible flexibility for strategic growth without any near-term funding worries. They can be opportunistic, maybe look at M&A, or be aggressive with international expansion, all because they have that capital backstop.
That financial muscle is what really fuels their competitive moat.
Mm-hmm.
So let's transition into that moat now, because capital is great, but it's the technology and the strategy that differentiate them from, say, a competitor who's just focused on beginners.
Right. And Webull is laser-focused on being an all-in-one platform.
They're trying to consolidate everything.
Yes, exactly. They've made a real strategic push to put multiple asset classes in one interface. Equities, options, crypto, even international markets. They want to be the default terminal for that sophisticated retail trader.
The person who needs the advanced charting tools and analytics.
The very same. And they're building a technological barrier to entry to get there. They're investing heavily in AI-driven tools, most notably with the launch of Vega AI.
And this isn't just a simple chatbot, right?
No, not at all. Vega AI is designed to really differentiate the platform for their power users. It's geared toward providing real-time market insights, maybe some algorithmic trade assistance, pattern recognition tools.
Stuff that usually only institutional traders would get access to.
Exactly. If they can successfully democratize that level of algorithmic power, it creates massive loyalty. Huge stickiness.
But the strategy isn't just about tech, it's also aggressively geographic.
Oh, absolutely. They are executing a very systematic, very ambitious international strategy. They just consolidated their Latin America app, merging Brazil and Mexico into one powerhouse.
And they announced they're moving into Europe.
Yeah, that was in September 2025. This geographic diversification is essential. One, it taps into huge new markets for growth. And two, it's a hedging mechanism. It reduces their risk of being tied to any single market or, crucially, any single regulator.
Which leads us directly into the risks. But before we go there, let's talk about near-term catalysts. For investors watching this over the next 3 months, what could really move the stock?
Okay, the immediate critical focus has to be the Q4 2025 earnings report. We're expecting that in, January or February of 2026.
After a Q3 blowout like that, expectations are going to be really high.
Extremely high. This next report is paramount. They have to show that profitability is sustainable, that the operating leverage continues, and that they're still acquiring customers at this accelerated pace.
And there are some seasonal tailwinds that should help Q4. Right?
For sure. In this industry, you often see a bump in trading activity during the December holidays, and more importantly, during year-end portfolio rebalancing and tax loss harvesting.
That should give a natural lift to volumes.
It should. And then beyond the hard data, there's a lot of market chatter you can't ignore. We're hearing speculation about accelerated institutional adoption.
So moving beyond just retail.
Exactly. If they can successfully court institutional clients for custody or partnerships, that would be a huge validation of their platform's security and maturity that could easily spark a rally.
What other rumors are out there?
Mostly around strategic activity, maybe some M&A or the official unveiling of those AI tools we mentioned, like Vega AI. If that launches to huge adoption, that's a clear short-term win.
And from a technical standpoint, the chart looks pretty good.
It really does. The stock has already shown a strong bullish reversal. It's trading comfortably above both its 50-day and 200-day moving averages.
So the market has already digested that Q3 news and sees it as a turning point.
The technicals strongly suggest that, the trend is shifted from neutral to positive, and the sentiment backs it up. We've seen positive insider buying trends, with executives adding to their stakes.
That's always a good sign.
It is. And you couple that with institutional inflows, which are also picking up. It suggests the smart money is moving in.
Okay, so as analysts, we have to keep it balanced. After all that upside, we absolutely have to talk about the key risks, the bear case.
We do, because these are high-stakes operations. And the primary risk here, the one that hangs like a regulatory sword over the whole sector, is payment for order flow.
Let's define that clearly.
Right. So Webull's revenue mix is significantly exposed to any regulatory changes around PFOF. For those who don't know, PSOF is the compensation Webull gets from market makers for routing customer orders to them.
It's a foundational part of their business model.
A massive revenue stream. But it's facing increasing regulatory scrutiny, particularly in the U.S.
So if there's a ban on PFOF in the U.S.,
it would force a dramatic restructuring of their model. They would probably have to introduce commissions or fees, which could really damage their competitive edge against other zero-commission brokers.
The international expansion helps with that, but U.S. revenue is still key.
Absolutely critical. The other big risk is just market volatility dependency. Their incredible revenue growth is tied to high trading volumes.
So if the market gets quiet.
Exactly. A long period of market calm or a big drop in retail trading if, the economy softens, that could suppress activity and instantly put pressure on those high operating margins we were just celebrating.
And lastly, what about execution risk?
That's a big one. We praise them for achieving that operational leverage, which requires really disciplined cost control. But they're doing that while also funding aggressive global expansion, and huge tech investments.
It's a difficult tightrope to walk.
A very difficult one. Can they keep their costs in check while pouring money into R&D and global market entry? That is the management challenge for 2026. If they stumble, that operational leverage could just disappear.
So that's the whole story, really. They proved the model works in Q3. Now they have to prove it can scale globally without losing that cost discipline.
Webull has clearly established powerful momentum. They're transitioning from a pure growth story to one about sustained profitability and scale.
The next few quarters are a critical execution phase. The foundation's there, the war chest is ready, the tech is being rolled out.
Now they have to deliver. If they can maintain this trajectory of accelerating revenue and margin expansion through global execution, the market should reward them for it. They could become a really formidable global player.
It's definitely a story of rapid growth transitioning into maturity and global scale. The market will be watching those Q4 numbers closely for confirmation. If you want to stay on top of how Webull executes this strategy and how those Q4 earnings shake out, make sure you subscribe to Investing Talk podcast to get our next update.